Good afternoon, everyone. Today is Friday, the 8th of March, 2013, and this is Brian Shannon from AlphaTrends.net speaking. Let's take a look at the action for this week. We had the markets really substantially higher once again. The S&P 500 gained 2%, NASDAQ about the same. Russell 2000 continues to go into new high territory, up 3.1%. The Dow was up to all-time highs, I'm sure you heard, up 2.1% for the week, and really it was only bonds that suffered, and obviously a lot of money coming out of bonds and maybe going into equities. Let's take a look at the action on the charts here. We came into the week thinking that maybe this market would be a little bit more neutral this week after the large volatility we had seen, and that perhaps the market needed some time to consolidate. But after Monday's late strength here, and then of course Tuesday's gap up, that immediately became apparent that this market wanted to continue to move higher within this overall uptrend that we've been in for several years now. The S&P 500, actually, if you look at the closing high, at least on a monthly basis, if we were to close here, this would be the highest it's closed at the end of the month. Obviously, we've been higher, but we're up to these highs that we haven't, that have been tested here a couple times in the past. You will hear triple top this time, and who knows what's going to happen. What we need to do, and what we always need to do in an uptrend, is just remain focused on risk management. The benefit of the doubt will always go to the buyer until we break through key levels of support. We saw that 2 weeks ago, that our first little intermediate term level of support was broken, and then we came down and tested a bigger level, but the market recovered from there, and we have to look at it and say, well, because the primary trend is still higher, we get cautious while we break these intermediate term levels. That means, turn to the sidelines a little bit, look for the lower risk setups, and maybe get stopped out of some things. That's the market doing its job and telling us that maybe it's time to move into different types of stocks. But we broke out and we continue to move higher. In fact, if you look at since the breakout 4 days ago, we remained pretty much above the volume weighted average price of that move the entire time. So the volume weighted average price since the gap right now is at about 154.70. I think that next week the key level we'll really want to see hold is right here at about 154.20. If we can stay above that level, it doesn't mean we're not going to see a pullback down towards there, and that's where we have the 5-day moving average as well. I mean, we could get a pullback down towards that level, and it would be a good little short sale for some more aggressive day traders. But the primary trend is higher, and even breaking below that 154.20-ish level would just turn us a little bit more neutral over the intermediate term, and we think that, well, maybe the market needs to come down and test that 153-ish area. But that's all speculation. What we have right now is we do have the wind to our backs. We have an uptrend, and we have a market telling us that the path of least resistance continues to be higher, and that it looks like it wants to go and test the all-time highs in the S&P 500, as it has done in the Dow Jones Industrial. The Dow Jones, the DIA is the ETF for that, is again up, at all-time highs here, and closed at all-time highs last 4 or 5 days in a row now. If we look at the intraday time frame there, we've got, even since the gap higher, just a nice little uptrend channel of higher highs and higher lows. You've got no business getting bearish until at least one of these little shorter term higher lows breaks. But corrections in an uptrend often occur through time as well. It wouldn't get us bearish. What we look for is maybe the 5-day moving average begins to decline, and we see a pattern of lower highs and lower lows below it. But until then, we look at the market objectively and say, here's what could be happening. And we did see that inverted head and shoulders pattern, which measures out from about 149, real conservative, to 153. So if we take a break, let's just call it 150. Well, okay, so 149 to 152.5, let's call it. That'll be pretty conservative. That would give us 3.5 points of upside from the break of 152.5. So that would give us a price objective up near about 156. That's just a measured move. It's not the target where you need to look to sell short. It's a potential level where the market may in fact go, but it's not showing any signs of slowing down here. The Nasdaq broke beyond that important level, and that important level was, of course, this area we've been focused on, which had been resistance throughout the year, and then this little band up in here. Well, we broke above two key levels this week in the Nasdaq, so real powerful move there. In the intermediate term, $68.40. That's what we're going to want to see hold next week. If we break below that, though, I don't think it would be a disaster to get back down to about $67.80. That was kind of the band of resistance, 67.80 to 68.20. So if we got back into that band, I wouldn't see it as a disaster, but the uptrend is continuing to exert itself here. We spoke again last week about this potential for the for a head and shoulders pattern, and it looks like that is not in fact occurring. So you can look at this and say, hey, it's a right shoulder, and that might have brought more fuel to the fire here. That is, that bigger participants may have been trying to push this market lower and fulfill that right shoulder, but as we know, we shook out below the lows of the year, and from there the market has just marched higher, squeezing shorts along the way and bringing new money that's been sidelined to the markets to continue to enjoy this uptrend here. So 68.40, I think, is the key level that we want to stay focused on for next week. Realtick, by the way, is the sponsor of this show each and every Friday when I upload it to YouTube. So take a look at realtick.com. They are the software here that we're looking at. And by the way, that orange is a 5-day moving average. Using intraday timeframes. If you're unfamiliar with that, there's some education on alphatrends.net under favorite posts that explains how that calculation works. As we know, the Russell 2000 has been has broken out early this year to all-time highs, and it continues to get extended, and we can look at it and say, it's up too much, or whatever you want to say that might allow you to justify to yourself a short position, and that you try to pick a top. But you look at it, we closed right at the high here, and even since that gap higher above that 91, well, actually, this is something that we had observed for subscribers on Alpha Trends on Monday, saying that we got above the 91, so it's officially broken some resistance, and it should continue to move higher here. We are above a rising 5-day moving average. So we gapped up, of course, and now broke out to all-time highs once again. So next week, I think we'll want to see this prior little peak here and what was resistance middle of the week very briefly. We'll want to see that hold as support at about 92.60, 92.50, let's just call it, and we'll have that rising 5-day moving average coming up to it. A pullback to the 5-day moving average to this level would not be a negative thing for the market. It might provide you 1 or 2 days to take advantage of some intraday shorts, but I think that holding shorts overnight in this environment is a mistake, unless you've got a stock that's in a clear downtrend. And if it's in a clear downtrend, still, bull markets are just so much easier to make money in because you don't get those violent short squeeze rallies. So focus on where the easy money is, and that's on the in the uptrend. The semiconductors got back above their key level that we were looking at, which was that $35 about 30 to 40 cent level. So it broke beyond that. We pulled back and tested it. So this resistance pulled back, tested, held as a support for now. So next week we're gonna maybe get a little bit cautious if it breaks back below there, because in the semiconductors, again, we've got the Nasdaq. It's nowhere near all-time highs, of course. Let's just take a look at that for a moment. On the monthly time frame, and the semiconductors obviously are they've got this bigger level up near 40, but they've been enjoying a real nice uptrend here for a bit, and now with these lower highs, maybe we're going to break down a little bit next week. If that were to happen, I think that you want to keep a close eye on the semiconductors, because that could indicate that maybe the Nasdaq would follow. So we have a little trend line there, and we have this little support. We want to see that hold. Otherwise, it's just a potential that it could signal that perhaps the Nasdaq would want to violate this 68.40 level and pull back down towards that $67.60 level. Let's now take a look at the financials. As we know, we've been talking about these things as innocent till proven guilty, and most likely one of these days going to test that $20 level. I didn't think, and I still don't, think that it's going to get there, immediately, but it's getting a lot closer, obviously here. We're, what are we, about 10% away, I guess, $1.80, right? So we're about 10% away from that level that I think it eventually holds. So you look at the weekly time for or daily time frame rather. We saw a test of the rising 50-day moving average last week. I thought, again, I thought for all these markets that it was more likely we were going to consolidate, but we had with these rising 50-day moving averages that the longer term picture remains innocent till proven guilty, and that news and surprises often follow the direction of the trend, which is obviously higher here. And for the financials, they gapped up as well above this little band of resistance near about 1780 to 1790, and just continued to rally from there. We saw here on a 10-minute time frame higher highs and higher lows. So what do we want to look for to hold as a key level next week? I think if we got back down towards 1780, that wouldn't be a disaster. Our near-term level for probably Monday would be about 18 and a dime. If we hold above 18 and a dime, then maybe we correct a little bit sideways, but we've got strong uptrends here. There's no point trying to fight it. If you're going to be looking to the short side, I think you look for evidence intraday that maybe it's breaking down, and then day trade it. And then if you get a strong close for your position, that is, so a weaker market, if your position is up, then maybe you take a small piece overnight. But risks are to the sellers in here. Let's take a look at the bonds. I'm by no means really supremely interested in bonds or am a bond expert, but they have broken some significant support here from last year and earlier this year. We had seen that support break already, and then this band of support held as resistance once again, and we have lower highs and lower lows in the bonds below a declining 50-day moving average. So there's no reason to think that this market's going to turn itself around. It looks like it's probably headed for about 110, and if you look at the bond market chart and where it is right now, it looks very similar actually to gold, which had broken down over in here. And we talked about the possibility of it headed towards 150, and gold still looks like it's heading there, and probably get a bounce, and then we'll see if this bigger level breaks and really turns this gold market into a bearish market. Thanks for tuning in. Again, check out alphatrends.net. Follow me on Twitter, AlphaTrends. That's where you'll be able to see all the information I put out. And have yourselves a good weekend. Thanks for tuning in.